coming into the second part of this year.
Hey, Shonali, happy birthday.
Yeah, thank you.
Thanks for being with us. Shonali Bassett, going into earnings later on this week. Let's get to the story in the equity market right now. 6 minutes into the session, we're down about 0.8% on the S&P, and the Nasdaq down by 1.2%. A softer session on Wednesday at CPI. Later in the week, it's about the bank earnings. Lori Calvasina of RBC has this to say. Early indications have been that direct impacts on the banks in question were limited. Secondary impacts may take some time to play out, and we expect to see that discussion pick up. Let's pick up on that discussion right now with Lori Calvasina. Lori, great to catch up with you. Welcome to the program as always. Lori, talk to me about what's changed for corporate America since the collapse of SVB.
Well, I loved the comment that you made earlier in the program, John, about, confusing data points last week. And I think one of the most confusing things about the SVB issue was that if you looked at survey data that was captured right prior to that event, people were starting to feel better. You could see this pretty clearly on the Duke CFO survey and, as well as some of the other corporate surveys, that you were starting to see inflections in terms of their outlooks towards the broader economy after things had already kind of returned to recessionary lows. So you had that kind of positive momentum. People are feeling better, and then just this massive amount of uncertainty dropped on top. And I think that we've been trying to, sort of look for reactions in conference commentary. We did go through a lot of the 8Ks and press releases that came out initially after SVB. It looks like it was a relatively well-managed sort of crisis in the moment of, but of course it's these secondary impacts. And I think that's really what's going to be the focus. Obviously, clients are very concerned about the lending environment going forward. It was already getting worse. How much worse can it really get? I think you're going to really see the sell-side community pressure the banks on that issue coming up.
The Federal Reserve barely changed its projections. I wonder if it's too early for corporate America to do anything different. Do you think it is too early for the C-suite to provide a change in the outlook?
I think that they're going to get asked and they're going to have to answer, and how they answer, I think, is going to determine some of the reactions early on. And you'll see other corporations, other C-suites sort of look at that for clues and adapt as we go through. I think that's, one of the patterns we normally see. And unfortunately, the financials are always on the hot seat early. So they do have to take some of the hits early on before the rest of corporate America can adapt. But I'll tell you, John, we've also been watching, not just earnings estimates from the sell side, but we've been watching economic forecasts from the sell side. And for all the talk about how this is worsening the macro outlook, you really haven't seen GDP forecasts budge all that much. You haven't seen recessionary expectations in the U.S. budge all that much. So on the one hand, I think there is this macro uncertainty. People are feeling a little bit worse, but you haven't actually seen it translate into numbers yet. And I think that's interesting. I don't think that this is a question of people being asleep at the switch. I think this is a question of the forecast community really trying to do the work and figure it out, and not quite ready to make any firm conclusions yet, but also not ready to write this economy off.
There's always a big conversation about what we're priced for in the equity market going into earnings season. Are you seeing any signs whatsoever, Lori, that in the stock market at least, this story's stabilizing?
I think it is. And, we spent some time looking at WorldCom and Enron and how, the growth stocks performed, after both of those events. We also looked at the financial crisis and looked at how banks performed after that. And, with the risk of saying things that are a little obvious, you saw the banks continue to be weakened after both the Bear and Lehman bankruptcies, which were telling you that we weren't really close to a bottom. But after we got the WorldCom bankruptcy, growth stocks did really stabilize. And so we've been watching the KBW Bank Index, and it's looking to me, not a technician, but it looks to me like it's trying to hold. If you look at where it's been relative to NASDAQ 100, it's been bumping up against some interesting 2020 lows. The small caps also have looked like they're trying to stabilize versus large. If you look at kind of where they've been recently versus where they were last May when they made their relative low for the year. So I think the stock market's in a little bit of a holding pattern right now. And, John, I think this is important because people keep saying equities are asleep at the switch and the bond market is smarter and the MOVE index knows something, the VIX doesn't. I'm an equity person, so I don't really buy that anyway, that equities are just dumb. But I think that equities are kind of, sitting here trying to digest the information and keeping calm for a reason, frankly.
Lori, I know lots of people like to say the smart money's in the bond market, and perhaps to some extent it is. But last week at one point, the 2 years in the 360s, then it's north of 4%. We're seeing monster moves every other week, Lori, in the bond market. What kind of signal can you take away from a bond market moving that much?
So look, I think it's the same kind of signal you would take away from the VIX, and we run all these back tests, and it's always impossible, right, to call the actual peak in these volatility indicators. But what we do know is that when they spike to these incredible extremes, if you just run the math, it's typically a buy signal for equity markets on a 12-month forward basis. And what that is a reminder of is that you do need to keep a cool head during times of crisis and really take advantage of dislocations. So that's really what I feel like I'm seeing, whether it's some of these volatility indicators in the bond market or if we're looking at things like AAI, net bull bears, we feel like we're starting to see signs of extreme stress having returned, which is encouraging us, just frankly to keep calm and carry on.
11 minutes into the session, we are down about 0.7 on the S&P. On the Nasdaq, we're down about 1.2%. Laurie, from a sector perspective, what are you advocating for at the moment?
So we still want to be balanced. I had one client call this a tri-bell approach, but we really want to be in the best of defense, the best of growth, and the best of value. We did reduce our cyclicality a little bit this morning by pulling down financials. Admittedly, we wish we'd done that a month ago. We just moved to a neutral, but we really feel like within cyclicals, energy is going to be your better story right now on kind of a longer term view. We think the case there is just, much more solid. There's too much uncertainty around the financials. If you look within growth, we think consumer discretionary has a big valuation problem, but we think tech valuations are more reasonable than many people realize. And along with industrials, it's the only sector that's back in positive revision territory. Now we'll see if that sticks, but I do think you saw max fear and max negative sentiment on tech's earnings last year, and we're in more of a recovery mode right now, or at least kind of an initial healing phase. And then I think on the defensives, we actually found that healthcare is starting to look a lot more interesting to us. We'd had some valuation concerns a few months back. Those really look like they're in the rearview mirror. It's probably your most reasonably valued defensive right now. We still like utilities, but it's started to get pricey, so we'd prefer healthcare over utilities. But frankly, John, I think we're going to have a lot more twists and turns. The choppiness isn't done. Still think there's a good chance the October lows hold, but I think it's going to be impossible to really trade all these twists and turns, so we want to have some exposure to each of these buckets going forward.
Can we just talk about the characteristics of some of the sectors within those buckets? Laurie, I just wonder, is tech defensive to you or cyclical?
I think that we divide things up into three buckets, but I do think in this particular environment, it is more defensive. And I think that the rate story, the Fed story is really still in play. We've been pre-trading it all year, but I do think it's still in focus for now, just these transitions in Fed policy and technology, kind of classic GICS tech does tend to be your strongest performer if you look at the historical performance of sectors following final hikes and following final cuts, our first cuts rather, it's also one of the strongest sectors. So, whether you're looking for a pause or the start of cuts, it's really something that you should be looking to. And again, I think it was hit so hard in terms of earnings sentiment last year. It really got de-risked from that perspective, at least more so than other sectors like financials, frankly, which only entered their downward revision cycle at the beginning of this year.
Laurie, love hearing from you. You know that. Always enjoy it. Thanks for being with us. Laurie Cavacina there of RBC. About 13, call it 14 minutes into the session. We are lower by 0.6%. On the Nasdaq, down by a little more than 1%. We're negative here by 1.1%. Coming up, more Tesla plans coming to China.
They have the scale that no one else has in terms of from capacity, from a battery perspective. That's really them flexing their muscles again in terms of what you saw with the China news over the weekend.
A conversation next.
they have the scale that no one else has in terms of from capacity, from a battery perspective. That's really them flexing their muscles again in terms of what you saw with the China news over the weekend. They're starting to build out in the U.S., but the reality is not just for Tesla, it's for Apple as well. I mean, you look at it, that's the hearts and lungs of the supply chain of their production. And I don't really see that changing dramatically in the near term.
Shares of Tesla falling for a fifth consecutive session. It's the longest losing streak of the year so far after slashing prices of US vehicles yet again and announcing plans to build a new battery factory in Shanghai. David Welch joins us now from Detroit for more. Now, David, there's two ways of looking at this price cut debacle. Either one, there's a demand problem. That's the negative way of looking at this. Or two, this is strategic genius. It's about maintaining market share and it's going to hurt others. Which one is it, David?
I think it's sort of somewhere in the middle, John. First off, for the longest time, Tesla's basically had a monopoly on electric vehicle sales. There were a few others out there, but they were low volume and they didn't compete directly with what Tesla had. You eliminate that by bringing out all these new EVs to market from Hyundai and Kia, General Motors now, Ford has some out there, and they're going to have to cut prices just to stay competitive. Their vehicles are still very expensive compared to the average vehicle on the market. The other part of this is that you've got rising interest rates and other things, and even wealthy people buying EVs are not immune to that. Monthly payments can be very high on a $60,000 vehicle. So you put all that together, along with having to get their cars under certain thresholds to meet Inflation Reduction Act incentives, and they've had to cut prices by at least 20% on all four models this year. I do think, to your point, that they are also trying to crowd out some of their competitors and make it tougher for them to make money on these. And they've got the scale in terms of battery and manufacturing of EVs to be able to do that right now. They can't do it forever, but I think they can make life tough for those, let's call them new entrants to the new electric vehicle business, because we can't call them old entrants even though they've been around for hundreds of years.
Well, it's true. David, where do you think the Shanghai facility fits into this strategy?
Yeah, well, for the longest time, Tesla was seen as not just a car company, it was a technology company. And those mega packs, it's not about the cars, although it does help them get scale for the batteries they're making for the vehicles. It's about stationary storage to supplement the grid. And Tesla has a solar business. You can't really use renewables that well on the grid without having some kind of storage. It does help, but any power generated for the grid has to be used almost immediately, and you make solar and you make wind power when the sun shines and the wind blows, and you can't control that, and is that when you need it. So what would make renewables really work for the grid is being able to store that energy and use it later, and that's been a part of their business going forward. So they're not just relying on electric vehicle growth. So I think it fits in terms of supply chain. Battery makers like growing volume, they like stable volume, and so having another place to put the stuff you're buying from the battery makers helps them out and gets you guaranteed supply for your cars. And also it's another business that Tesla can grow besides the car business, which is softening up for them.
David, we're going to catch up soon, no doubt. This one getting a ton of attention this morning. David Welch there, 5-day losing streak on Tesla. Over those 5 days, down about 14%. Bear in mind that year to date we're still up by close to 45% on Tesla. Analysts weighing in on this one, including Piper Sandler, saying this: while obviously a headwind for margins, we think price cuts are more problematic for peers than they are for Tesla. Let's talk about that now and get over to Kelly Lyons. Hey, Kelly.
Hey, John. Well, it's certainly not more problematic for peers this morning in terms of the share price reaction, because the losses for Tesla are far steeper than some of its competitors, which frankly aren't even underperforming the broader market this morning. Take a look at Rivian, down just 0.25%, Lucid Group down just about 0.5%, Fisker barely down at all. But in theory, John, yes, this is a competition question for them here, because these price cuts could, as you alluded to, signal that there is a problem with demand, but also could just mean that more competition is coming. Interestingly, though, on the subject of competition, as you were just discussing with David, the plans for the battery plant in Shanghai, other Asian EV battery suppliers actually rallied overnight to the tune of nearly 3%, though Panasonic is a bit of an outlier here, so maybe it's less of a problem in the battery space, where there may or may not be the same demand question. Finally, just to put this entire EV stock story into a longer view here, take a look at BI's global EV index. Over the last 5 years, up 153%, but actually down by more than a third since the peak in November of 2021. Is that a case of stocks just running too far ahead of themselves, John, or does that actually just showcase the demand issues that may be coming into the space here.
Hey, Katie, thanks for that. That stock is down by a little more than 4% this morning. The broader market's lower. We're down 0.75% on the S&P. The Nasdaq near session lows. Let's get you some sector price action. Back with us, here's Katie.
Hey, John. Well, energy is leading the charge today. You can see that sector up 1.7%. On a down day for the index, you look at what's dragging it lower. It's the tech sector off by 1.7%, really offsetting and then some the gains that you're seeing in energy. Let's quickly look at the stocks, though. This index still up about 21% year to date, even though we know chips in focus today after Samsung cutting output on those memory chips.
Katie, thank you. Tech struggling this morning, that's for sure, with the Nasdaq underperforming. Up next, your trading diary.
Jobs Day, like Bloomberg.
25 minutes into the session, equities lower, struggling this morning, down 0.75% on the S&P. On the Nasdaq, tech really underperforming here. The Nasdaq 100 down about 1.4%. That's the price action. Here's the trading diary. What you need to be looking for: President Biden heading to Ireland and the UK on Tuesday, plus Fed speak picking up again with Harker and Kashkari. The FOMC minutes and US CPI on Wednesday. Wednesday, a big day for data. Then on to Thursday, ahead of PPI and another round of jobless claims. We get Friday. Earnings from JP Morgan, Wells Fargo, Citigroup to round out the week a little bit later this week. After a big month for the banking system in the United States of America, arguably for many, including Zach Griffiths of Credit Sites a little bit earlier this hour, many think that maybe the bank earnings more important than what we get from the data from CPI on Wednesday. We'll pick up on that story a little bit later. We'll be down in Washington, D.C. through the rest of this week. Tom and I are going to head down tomorrow morning. From New York, this is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, April 10th. Here are the top market stories that we're following for you at this hour. The market tea leaves, stocks versus bonds. Equities grind higher while bonds still point to a recession. We're going to find out which side is right as we head into earnings season and CPI Wednesday. And then you got the tech tea leaves. PC shipments sink in the first quarter. Apple's fall hard. TSMC misses its sales estimates for the second quarter. The Nasdaq is off over 1%. And the manufacturing tea leaves. We speak to Nick Pinchuk, CEO of Snap-on, a high-end tool maker, to get his read on the economy, jobs, and inflation. From New York, I'm Alex Steele. I'm solo today. Guy Johnson is off today to celebrate the Easter holiday. Welcome everyone to Bloomberg Markets. I'm here with you for the next 2 hours, and because Europe and European bond markets are closed, it kind of gives us a chance to delve into what's happening solely within the U.S., and that's the strong divergence that we've seen with the equity and the bond market. You have data, you have Fed cuts still being priced in, but then you still have equities holding up relatively well. I appreciate we're trading a little bit heavy today with the S&P down about 0.7 of 1%. However, we're still pretty strong over 4,000. So that leads us to the question of the day. And I like tea leaves today, in case you didn't get that from my open there. What's right? Equity or bond markets? So here's a good chart that kind of shows the divergence we're talking about on a short-term basis. It just takes the 2 days of futures trading and also bond trading that we've seen. On the one hand, you got bond investors holding their ground, right? You have yields still holding up above their earlier levels. You do see sort of heavier trading. On the flip side, you have Friday's equity action. You got equities up, then you got equities down. Equity investors can't seem to make up their minds, whereas bond investors solidly seem to think we see higher yields. Is this right? Does this make sense? Let's kind of dig through this a little bit more. Joining us now to discuss Bloomberg's Kriti Gupta and Katie Greifeld. Guys, thanks very much for joining me here. All right, Kriti, let's start with you. Are equity investors fickle? Do they not know how to make up their mind? Or is this a positioning story right now for the equity market?
Well, if you're one of those bond traders who says, oh, those equity guys, then yes, they are absolutely
That's Katie's
fickle.
side. Katie's taking that side.
Well, I think a fair point to say is, do you believe the Fed or not? Because I could argue it both ways. Let's say hypothetically you believe the Federal Reserve. You are going to be extremely hawkish. Put this into the perspective of the last year or so. There's been so much carnage. There's been so much repricing. Even though there is this narrative that, say, tech stocks or the broader market is still overvalued, it's been overvalued for a decade by the same kind of metrics that we're using, PE ratios, debt to sales ratios, et cetera, you pick. The question now is there more kind of room to run? And that's really why you're seeing the stock market trade more on margins than anything else. We had Stifel's Barry Bannister on last week on Bloomberg Television. He said, look, profit margins have peaked for the entire decade. And if that's your narrative, then why are stocks still higher? And the answer is because all the carnage, all the repricing, all the recessionary talk, that was the 2022 pricing in. Now we're looking forward to what happens post-recession. The flip side of it is if the bond market is right and you are going to get 100 basis points of cuts, then again, the stock market is ready to rally off that because at the end of the day, cuts are good. So either way, stock market bulls kind of win here.
Katie, do you agree with that? Who's right?
It's hard to say. I do want to talk a little bit about the bond market here because I talk to a lot of bond guys. I cover bond markets pretty closely. And if you look at really under the hood of the positioning data, it seems to suggest that maybe what we're seeing is the after effects of what has been a massive short squeeze. Think about what happened in March. We know that heading into the SVB episode and all of the chaos that followed, if you want to call it that, that speculators were at a record net short against the 2-year Treasury yield. And now you have 2-year Treasury yields really trading still a full percentage point below where they were heading into March's episode. And then you look at credit markets, you look at stock markets, they've really shook off the bulk of what happened. So think about the bond market, what that's pricing, and those 100 cuts that Kriti mentioned, 100 basis points of cuts. This could be more of a positioning story than really a fundamental reflection on what is going on in the economy.
Right, I think that's such a good point, and we learned that from the CFTC data, as you were mentioning, right? You had some shorts within the S&P, right? So therefore, you're going to have short covering, which helps to elevate the equity market versus bonds, where you kind of had some exhausted selling. So, Katie, when you talk to the bond guys, how are they going to make sense of the Fed hikes and then also the bond market and positioning at the same time?
I mean, a lot of the bond people that you would talk to would tell you that something is out of skew here if you look at the bond market. And I actually wrote today's Big Take with Liz McCormick. We talked to a lot of bond guys specifically for that story. And I love this quote in here. It's from Bob Elliott of Unlimited Funds, that every day that there isn't a banking crisis, and we've had quite a few of those days, it's another day indicating that basically what's being priced into the bond market is really out of step with the fundamentals on the ground. But the thing is, we had a lot of hedge funds, a lot of those big macro players really get burned over the past few months. So if you think about who is going to step in here to try and push yields higher and bring that pricing more into line, a lot of those players are still licking their wounds.
So, Kriti, when you mentioned the fact that you could look at equity markets, they might have it right either way. Is it just a timing issue then? Because in theory, I understand if you have rate cuts that you're going to want to buy equities. I kind of get that link. But if we see 3 cuts, when the data may not be reflecting that, and bond traders see something different, things must get really bad then to get those cuts, in which case, why would you want to own equities?
Right, and I think actually the piece for a lot of macro investors, to your point of why they would probably not want to own equities, has less to do with the actual fundamental narrative and has more to do with liquidity and positioning, as Katie just talked about. Look, one of the big issues here, specifically with the volatility of the 2-year, was just how much VaR risk can you actually take? And one of the immediate reactions when you saw that bond volatility was that bonds were leading the charge, not as a ripple effect into stocks, but that if your yield goes down dramatically, 20, 30 basis points, which we have seen, by the way, during that bank volatility, your immediate reaction is to pull out of the market altogether. And you saw that in open interest in commodities. You saw that in the stock market. You even saw that in the currency market. All the flows went straight to the dollar, even though yields were going in the opposite direction. So again, when you look at the equities picture, I think it's fair to say that equities and bonds are not reacting to each other in the way that they did perhaps in 2022 and arguably 2021 as well, because the fundamentals are not driving the equity market. It is a very stock-specific story.
Right, which also then brings the question, will earnings then matter? So will earnings be the thing that is the catalyst where all of a sudden you have the equity markets more paying attention, quote, to fundamentals?
Yeah, they will temporarily. And here, there's a major caveat.
Unless we're looking through 2024 and then you're like, everything's okay.
Right, and well, that's the point, right? That right now they're trading on margins. And again, I'm going to bring it back to the story. If you believe margins have peaked, then your incremental gain in the next quarter or even 2 quarters is going to be just how much cost efficiency is there. And you're seeing that in the tech names, for example, where layoffs are rewarded by the stock market. You're seeing that in FedEx, for example. Restructuring was seen as a major positive. You're seeing that in Tesla when it talks about price changes trying to capitalize on the consumer. Where you're not seeing that, though, is saying, look, we are going to grow X% in the next 5 years because of ChatGPT, because of AI, because of whatever your reason may be. That's not the narrative that's happening. So it is a very short-term view for equity investors, and I think that's why you're failing to see the breadth that you need for a sustainable rally, where it is a very top-heavy market right now.
So, Katie, just to round this out in terms of the bond conversation, we are picking up a little bit of selling here. You got the front end up by about 2 basis points. Last week, I was saying, are we going to see 355, which would be the low for the year, versus 4? And it felt like people were more trending towards 355, and now we're like a stone throw away. Well, we're actually now hitting 4.
Well, it seems that, I mean, for the 2-year Treasury yield, where we head from here is going to be really important. Whether, I don't know, maybe we don't get back to 5%, which we were looking at just about a month ago. But in terms of where we are right now, below 4%, again, a lot of the folks that I'm talking to say that's way out of whack. But just to wrap this bond conversation into the earnings conversation, of course, we get bank earnings this week, and then we get some regional banks in the weeks ahead. And that matters very much for the macro environment right now. For some of these players trying to piece together just how, I don't know, stressed, if you want to call it, the banking system still is, whether we have seen loan growth slow significantly or an expectation that it will. When we're talking about getting the bond market back into tilt with what some of the other asset classes are saying, those numbers are going to be very closely watched.
Right, and it's one, you know, if we get the softness from banks, is it going to be go buy bonds for safety, or is it going to be we're in a bit of trouble here?
Or go back into cash. A lot of people are taking that trade.
Yeah, a ton of people going into cash as well. We are slowing that ascent, though. All right, guys, thanks a lot. Great way to set up the week for us. Really appreciate it. Kriti Gupta and Katie Greifeld joining us. And you can read more about which one got it right. You got equity or bond markets in Bloomberg Big Take. Katie was mentioning that. And Bloomberg's Liz McCormick wrote about how the bond market risk is overplaying the risk of a deep recession. You can read that on the terminal and on Bloomberg.com. All right, coming up, more on the question of the day. What's right, equity or bond markets? Callie Cox, eToro U.S. investment analyst, joins us next. This is Bloomberg.
this week. Surveillance is live from Washington, D.C. as part of Bloomberg's extended daily coverage of the World Bank Group and International Monetary Fund's spring meetings.
These meetings, even with the banking crisis in place, are really, really important.
Economic outlook, poverty eradication, aid effectiveness, and more.
How slow could global growth get?
You could have a global recession.
Live coverage throughout the day starts April 11th on Bloomberg, your global business authority.
The only time that you can really prove that you're in a recession is after it already started. Until then, you cannot disprove a soft landing scenario. So, Tom, I'm leaning toward it's going to become a bigger issue than people give it credit for.
That was Tony Dwyer, Canaccord Genuity Chief Market Strategist, speaking on Bloomberg Television earlier this morning. So let's get to the question of the day. What is right, equity or bond markets? Joining us now, Callie Cox, eToro U.S. investment analyst, joins us now. Okay, so the bond market's telling us one thing, and the equity market still is resilient, no matter what kind of eco numbers we wind up getting. Also a little bit whippy, we should say. We have the S&P down by 0.5%. What do you think? Who's right?
Yeah, so I'm going to throw a different take at you, Alex. I think they're telling the same story, but to different degrees. I mean, the bond market, you can argue there that the bond market has been screaming about a recession for about a year or so through the yield curve. And equity markets, I think, are getting on that bandwagon. Just over the past month, we've seen defensives outperform. We have seen big tech rally, but in a defensive way, showing that investors are searching for quality. So I do think that there is a rotation happening within the U.S. stock market at the moment, even though prices are moving higher. And it's important to remind people that prices can move higher in nervous markets too. Prices, especially over the short term, aren't indicative of the economic outlook.
But that leads me to breadth. I mean, it feels like the breadth for the S&P has been really, really bad. We are just having a handful of stocks that are really leading the rally. Does that point to what to the equitability of bonds and stocks in terms of what they're saying?
I think so. I think that's exactly it. We just haven't seen that kind of breadth that is inspiring if you think that this is an early bull market, careening toward an economic recovery. Another thing I'll point out, too, is small caps have been lagging larger caps by a pretty nominal margin at the moment, and that's not what you typically see off the lows. That's what we saw from October to February, but we saw that dynamic switch itself in March. And a lot of that is due to the fact that small caps, of course, a percentage of them are financials. Mm-hmm. But at the same time, I think what small caps are telling us is that, potentially the outlook isn't the same as what we were considering about a month ago.
So if I'm looking at the S&P at 4082, that's justified? We don't need to see a 3 handle for us to really price in what the bond market's saying?
Well, we're cautious here, to be clear. We think prices are kind of in thin air at the moment. It's really hard to tell because, of course, the pain trade has been higher here, Alex. But at the same time, if we are heading into that slowdown, if we are heading into that eventual recession, we do think some weakness could be priced in here, and we think stocks could potentially take out their lows. But it all depends on the degree of recession we see, or degree of slowdown we see, because we are not entirely convinced that we're, in recession grounds quite yet. We need to see more evidence.
So then what's the risk as we head into earnings season? We get banks kicking off on Friday, and we have the CPI on Wednesday. What's going to be the most important mover and signal for the markets?
So I think as we go into earnings season, of course, regional bank earnings are going to be really important. Bigger bank earnings important as well, but you have to remember that bigger banks have been the beneficiary from everything that's happened so far. We're going to be watching cyclicals quite closely, of course, because cyclicals are kind of the canaries in the coal mine when it comes to where the economy is heading next. But I think that the market has really started pricing in lower earnings estimates as well. I want to see how well, companies perform or companies release earnings relative to those estimates. And I also want to see sales performance too, because you rarely see a recession when sales are rising like they have been over the past few quarters, especially adjusted for inflation.
I mean, as Kriti was pointing out, though, that feels like maybe we were trading off of that in 2022. And then now the equity market's going to be trading more about once we get the cuts, 2024 is going to look great. Do you think that's going to happen? Do you see that as what's happening?
We do think if we fall into a recession at this moment, and it's really hard to tell to what degree, if we see a recession, how far it could fall or how severe it could be. But if we do fall into recession, over the next few months, if we see these banking cracks spread, I also think it's hard to say that this is going to be a little more systemic. So we could see that V-shaped rebound. And I think you should consider that as you position yourself especially for the next 6 months or so in your stock portfolio.
If you're thinking about that, where do you then go for safety?
So we like the barbell approach here. We like staying defensive because, of course, things feel uncertain and we're not sure how far the banking cracks spread. But we're really encouraging investors to look at that quality risk. Look at those big, durable companies with strong balance sheets and financial performance, especially as interest rates remain high at the moment. Of course, they could come down. That's what the market is expecting, but they're still high. So it's a rough environment, but we're really urging people not to completely let up on risk at the moment.
So, Callie, when we get the results that wind up coming in, is bad news going to be bad news? Is good news going to be taken as good news?
I think it really depends. I think it depends. So tech, as we've all seen, has had some pretty bad earnings. They're expected to have another bad quarter. But investors have applauded the fact that they're leaning toward, conservatism in terms of their operating strategies. We've seen a lot of big tech lean on more cost-cutting, more productivity-boosting measures, and investors have really liked that. So I think it's hard to say. Of course, banks are a special duck here, but I think it's going to be a sector-by-sector story there.
Yeah, it's really confusing. So it's like you want a barbell, you want to be somewhat defensive, but you don't want to cash out altogether. You want to take on some risk, but not too much risk. That's a really hard line to walk. What do bonds do in that kind of portfolio?
So if you think a recession is coming up, you have to consider bonds, especially the more quality bonds like treasuries, as that traditional recession hedge. Especially right now with yields high, of course, if you buy into bonds, yields go lower. But if you think if you think the economy is falling into a recession and ergo you believe that the market could take out its lows, it makes sense to play in a more defensive and protective state here. And we think bonds and cash could lend itself well at that point.
Is cash money markets?
Cash is wherever you can get that yield. I think it ultimately depends on your goals, but you can get yields on a savings account at the moment. You can get yields in short-term money markets. I think you just have to, consider the fact that there are different protections on each.
Yeah, no, absolutely. I'm seeing big signs now for like regional banks being like 4% in the savings. Hey, Callie, really appreciate it. It is a tough week to kind of parse through. You got the eco on one side, you get earnings on the other. Callie Cox, eToro U.S. investment analyst, joining us now. All right, still ahead, we're going to stay with tech. You got Apple leading the PC shipment plunge as pandemic-era remote work demand really dries up, and that sends unsold inventory soaring. We're going to get to that in the startup next. This is Bloomberg.
Great questions.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Simone Foxman. One of the big names in municipal bonds is calling it quits. John Miller is retiring as head of Nuveen's muni bond business. The retirement was announced in tandem with a separate release saying that Nuveen had settled litigation filed by rival Preston Hollow Community Capital. The firm had alleged that Miller had tried to blackball it by threatening and intimidating broker-dealers. China is further locking in its place at the top of global energy storage supply chain. Tesla plans to build a large new battery plant in Shanghai. The electric car pioneer will manufacture its Megapack large-scale energy storage unit there. Tesla already has an assembly plant for EVs in Shanghai. A tough start to the year for personal computer makers. Apple's PC shipments plunged more than 40% in the first quarter. Lenovo and Dell reported declines of more than 30%. The demand surge driven by pandemic-era remote work has evaporated. And that's your Bloomberg Business Flash. Alex.
All right, Simone, thanks very much. It is 22 past 7 on the West Coast. Want to get to the startup? We cover the top tech stories from the Bay Area and beyond as Silicon Valley starts this morning. Joining us now is Bloomberg technology co-host Caroline Hyde. Caroline, just stick with the Apple story for a second, because I'm wondering how much we're re-rating to pre-pandemic, like the froth is coming out, versus an actual slowdown in the economy based on PC sales.
Dare I say a bit of both? Like we're back at early 2019 levels. So this isn't Armageddon, but it does come down a lot. In large part, Apple is a victim of its own success here. It had an awful lot of appetite this time last year, so it had difficult year-on-year comparisons. But also some of the technology is aging a little bit. We know that we're going to be getting a new Mac lineup perhaps at the end of this year. So that's going to galvanize more people wanting to buy into certain new faster processing chips. They're going to be using their own chips, for example. But yes, this is a cooling economy. This is Apple having a big exposure to the consumer, to you and me. And actually, the CFO warned us of this, that you see double-digit slowdown in revenue, particularly in the Mac area.
And what I find interesting, this also comes, though, as Taiwan Semi, so TSCM, talks of missing their sales estimates. Samsung also warning that they're going to be cutting production as well. And I wonder what the read-through is for those guys.
And both doing some self-help on the back of it. TSMC, its big provider is Apple. They're a big supplier to them. If you go onto the supply chain function on your Bloomberg, you can see how important Apple is. So any issue and slowdown in demand from Apple, of course, hits TSMC. For a second straight quarter, they're missing in terms of their overall revenue and forecasts. They are doing some self-help by cutting back on capital expenditure. They're also having to think, okay, in this period of slowdown in chip demand, where do we reallocate our presence? Because people want to be diversifying their supply chain as well. They don't just want to be getting it from Taiwan. We're also seeing the likes of, as you mentioned, Samsung doing self-help by saying, look, we're going to cut back on production here. That means you cut back on supply. That's why actually Micron on the day is shooting higher.
Right. So I just wonder if we're just learning, like, right, remember, chips are cyclical, and now we're in a different part of the industry. We all forgot that, I feel like, in 2020.
Well, they all tried to tell us that it wasn't true anymore. I remember sitting down with the Micron CEO, and he was like, you know, we're gone from an age of peak, boom, bust. I'm afraid it's not. These cycles, they come back because that's the way in which you and I buy things.
Right. Well, because it was all like, oh, we have different stuff. We have the Internet of Things, right? We have EVs. IoT. It's a whole different story. Right. And we're learning that may not be true. I do find it interesting that Micron's up, though, on the Samsung news. Because supply helps pricing, helps Micron.
Yeah, exactly. Suddenly they can start to be more competitive. They can have better, at least throughput pricing. And I think IoT, auto demand, that will come. It's just it doesn't come overnight. And it's not in, companies have to allocate and decide the way in which they're spending on R&D right now.
Right, and also I think it depends on when that all happens. Like, how do you price that? Like, how do you actually value that and price that in?
And how do you ensure that you all get the right pricing point? You've got this sort of, difficult agreement. They're not in any way a cartel, but it's a little bit like the area that you're such an expert in of oil, that they all want to ensure that there's the right price, that they can all be making the right sort of profit margin, but also it's a competitive space.
Yeah, no, you got to have the price to incentivize production. It's going to Apple, though, down by 2.5% on that news. We shouldn't be surprised, but yet somehow the market is taking it on the chin. Caroline, thanks a lot. Really appreciate it. Looking forward to the show coming up in about an hour and a half time. Caroline Hyde, Bloomberg. Catch her as co-host of Bloomberg Technology at noon Eastern time. And speaking of, look at the NASDAQ 100 up by over 1%. I mentioned Apple down by 2.5%. So it's interesting. You may not have been surprised by the PC news, but has that adequately been priced in? Apple's telling you that it is not. And pay attention to the overall index, because Apple, one of the few companies that actually held up the overall index. His breadth has been so thin. All right, coming up, we got the latest jobs data. Did show some cooling in the labor market. We're going to get a boots on the ground view from Nick Pinchuk. He's the Snap-on CEO, joining us next. This is Bloomberg.
All right, we're about an hour into the U.S. trading session. Bloomberg's Kriti Gupta is looking at the moves. I have to say, volume pretty much going nowhere fast.
Yeah, and this is what happens when Europe and Asia, well, most of Asia.
It's Guy's fault.
I know. This is what happens when he takes off. Everyone just tunes out. I get it. Star Power by Guy Johnson, apparently. Take a look at the S&P 500, though. Still down about 0.7%. Look, you are seeing weakness, and it is a tech-driven weakness. A lot of this is going to be the micro, though, not necessarily the macro. To me, though, the interesting story is all in the bond market. We're going to come back to the semi story, because right now, on the surface, it's only higher by 0.1%, but underneath the surface is, again, where all the action is. We're going to come back to that. The dollar is interesting. You're seeing some strength here, up about 0.6%, despite yield actually coming down. So a lot of that, surprise, surprise, is actually driven by the Mexican peso. This is what we mean by it's a light volume day, when weakness in the Mexican peso is actually driving the Bloomberg Dollar Index higher as a whole, higher by about 0.6%. NYMEX crude really taking its cue from the dollar story, but not necessarily pulling back. You're not seeing that exit flows, an 80 handle on that commodity. But once again, I want to talk about the job market, because this is really important as we talk about just the moves from last Friday, or delayed moves of what there should be. Look at a 2-year yield. We're at about 4%. It has sustainably stayed below 4%. Now, it's interesting that you're starting to potentially test that level again as we talk about the end of the Federal Reserve's tightening cycle. And this is where it's interesting to look a little further out into the curve. The 10-year yield creeping closer and closer to 3%. What does that entail about the economy, especially as we get closer and closer to that May meeting? And And what does that might that actually look like? Potentially one hike left, only 25 basis points, and you can really see that pricing take a dramatic turn down and really just stay there. Does that change on Wednesday when we get that CPI report? How much of the commodity story is baked in there? So Alex, that's your macro for you. Let me take a quick minute to talk about the micro because, again, that's where all the action is. There are three major stories that you want to keep an eye on. I want to start with the oil one. Pioneer Natural Resources, right up your alley. You're going to love this. Higher by just shy of 8% on that stock after reports that ExxonMobil might be thinking of acquiring the shale driller. We can nerd out about it. Right now, all you need to know is the stock is moving fast and furious higher by about 7.5%. Like I said, the tech story is important. Apple shares down about 3%. They're talking about PC shipments declining by 40%. Is that indicative? Excuse me, I'm so sorry. This is what happens when you're so excited about markets.
It's 100% true.
Is it indicative of a macro story or is it indicative of Apple specifically? We're going to dive into that as well. Intel and Advanced Micro Devices. This is the stuff that really gets me excited because over the weekend, Samsung talked about a production cut. Now, it's showing up in two different ways. On the one hand, a production cut means that the economy isn't actually needing as many chips, and that is a negative sign if you look at chips as a bellwether. Intel is our kind of U.S. poster child for that, down about 1.4%. But then you have the likes of Advanced Micro Devices, higher by 1%. Again, if you have less supply, that means you can increase the prices, and it really depends on what stocks can actually feed the prices higher based on their inventory, and that really becomes a stock-specific story. Alex, how's that for a markets wrap?
That was great. That was great. We could definitely talk about Pioneer and Exxon for sure. We were doing that commercial break. All right, Kriti Gupta, thanks a lot. Super appreciate it. So let's get back to the job market. It did soften just a bit, giving the Fed some room to raise rates at its next meeting. Bloomberg opinion columnist Mohamed Al-Arian spoke to Bloomberg TV on Friday about that data.
For the Fed, this increases the probability that they'll go 25 basis points in early May. Of course, the CPI number is going to be important, but given this does not justify a pause given how they've been thinking. Second, it's good to see good economic news.
That's right. Good economic news. So let's get the perspective of someone who's seeing all the dynamics of the economy and labor market play out in real time. Nick Pinchuk is the CEO of Snap-on, a manufacturer of high-end tools and equipment. Nick, it is always a pleasure to get your perspective on this. It's good to see you. So let's just
great to see you.
Let's just start off straight up with jobs. Are you hiring right now? Are you laying off? Are you holding? You're hiring.
We're hiring.
More than
normal?
normal?
Hiring all across the country, and we're expanding our factories. 3 of our factories are being expanded as we speak. So things are going pretty well. Mohammed's right. Things are positive in terms of the economics. We say it's pretty encouraging. In our last conference call, we declared it as high momentum, and it is. You know, when you walk through the garages and small businesses, you see it. It's interesting, you know, when you look at the NAM, National Association of Manufacturers, they say there's 694,000 jobs available in manufacturing. And if you look at their outlooks, where they survey their thousands of members, you can see that the big companies are a little cautious, as they always are. I think big company CEOs forecast or foretell 3 of the last 10 recessions, because it doesn't pay to say the recession isn't coming if you're a large company. You have to be cautious.
Right.
But small companies are at a relative high. Actually, for the last 6 months, they've been over big company optimism, Nick, rated the future higher. So this is a pretty good time.
So, Nick, pair that with me with the regional bank issues that we've seen, because here's the macro story that I hear. Regional bank issues are going to feed through to small businesses. There's going to be a credit crunch in the small business. They're going to lay off people, and therein goes the recession for the economy. What are you hearing from your clients?
Well, I'm not hearing that. I mean, I think our clients certainly are small businessmen. And their balance sheets, one of the things that might be the thing, a factor in this is their balance sheets have never been stronger. I mean, our sales, if you look at Snap-on sales are up almost a quarter over pre-pandemic levels. So I think that the economy is in a really good place. You know, sometimes I think the Fed has got the wrong model. They're still captured by Arthur Burns and the Carter era. And it isn't the Carter era. Now, the banks are a different factor. But I do think that small companies are resilient, and they have the wherewithal to keep going in this situation. Now, that may be proved wrong over time, but, you see things like, I do believe when you talk to the consumer, people wonder, why is the consumer still positive? I would suggest part of it is coming out of the COVID. There was a tremendous level of optimism that has survived the bombardment of bad news for breakfast. Secondly, as I think is outlined today or a day or two ago in the Wall Street Journal, there's a reshoring. People are building up manufacturing, and this is good news for the small businesses of the United States.
Well, we'll get to reshoring in a second. I just want to get one more part on the manufacturing eco-landscape. So the ISM manufacturing data that we got last week was pretty weak. I mean, the new orders were pretty dismal. When you look at that compared to what you see on the ground, how do you reconcile the two?
Well, I think I'm looking at big companies versus small companies. I think small companies are larger companies are a little more cautious today. But when I talk to the small companies, they seem still robust. And the NOM data, the NOM outlook seems to support that. I do think there often is a dichotomy between that. In some ways, you look at, I've said this before in your program, that there seems to be a bifurcation between the economies. Maybe the big companies and the financial markets are one way and the small companies are another, and we live in the world of the people who work at small companies.
Fair enough. No, fair enough. Which then brings us to the onshoring, the reshoring, the friendshoring. So what are you hearing about that? Because in theory, that's going to make it a lot more expensive maybe to produce stuff at home. It's going to make, okay, sure, I get the supply chain will be easier, but there will be costs associated with that and difficulties in making that happen. What are you hearing?
Oh, I say, yeah. I mean, the thing is, yes, but would Americans rather have jobs or control inflation? You see, the thing is, I think Americans have voted on this. In the past, we maintained prices by offshoring. I think Americans would rather have their own jobs robust and have good jobs that keep their families warm and safe and dry and have pride and dignity. And they exist in the factories across this area. One of the difficulties, though, is expanding the skilled labor force that's going to do this. I was at dinner with a bunch of industrialists. Every one of them said, we want to expand in America because China now looks a little shakier, you know, in terms of supply. But labor was the big problem. So I wish that the nation would be less worried about controlling demand and more worried about expanding supply, and that is the American skilled workforce.
So, Nick, what we also have talking about is you have perspective pretty much globally, right? So you said that China's a little wobbly. Is China wobbly because of its relationship with the U.S., or do you see some underlying weakness there?
Sure, that's a factor, but I think the underlying weakness or the thing that was the wake-up call, I used to live in Asia 11 years. I've been in China dozens and dozens and dozens of times, and I was very positive about it. But one of the things that happened is when the current administration in China was willing to close Shanghai for 6 weeks, it became clear that they're willing to do anything. And so therefore, an unreliable administration meant that you can no longer rely on China as a source. This is what's happening as a source. It's too far away. We saw it in the COVID. Long supply chains are quite vulnerable, and they're liable to close a port or a city or things like that, so it's not so reliable anymore. So that ends up being an onshoring. There isn't a lot of great substitutes for China except for America. So that's why you're seeing this reshoring. You're seeing people like the Journal write big articles about it. The second thing, though, is I think people are viewing China through a bifocal lens. One is reliability as a source, but the scale of the Chinese market is enormous. Consider this. In electric cars, total cars, last year China sold double the number was sold in the United States. Double. And there's 6 times as many electric vehicles sold there last year as in America. So if you believe in scale, the power of the learning curve, China is a place where if you're a manufacturer and you want to compete globally in terms of technology and reliability and capability of your product, you want to be part of that market. This is, I suppose, why Tesla is expanding there.
Right, but it's a tricky line, though, for some companies when it's the U.S. and China and how to be frenemies, basically. Nick, look, it's always good to get your perspective. We really appreciate the upbeat take. Nick Pinchuk, Snap-on CEO, making good distinction there between the large companies and the small guys when it comes to manufacturing. All right, coming up, the other big event of the week is that banks are going to kick off earnings season Friday. We're going to talk about the recent banking turmoil and how that's going to factor into the results next. This is Bloomberg. Our U.S. bank earnings get underway this week, so investors are going to be watching what executives say about deposit levels and liquidity when banks start reporting on Friday. Bloomberg's Wall Street correspondent Shalini Basak joins me now. I have to be honest, I'm more excited about the regionals this year because they're the ones that are really going to be hanging on the balance versus the big guys. But what can we learn on Friday?
No, it is the truth. You want to see from the big guys how much they actually bought in terms of deposits and who were the big winners in this story, as painful as this deposit story might be. Remember, those deposit rates are not necessarily going up at the big banks, but there's a question in the market, the question of whether it's a bank run or a bank walk, as Jim Bianco and other academics like to put it, this idea that there have been about $900 billion of deposits moving out of the banking system since the rate hike story really began in early 2022. Now, because we're not over yet necessarily, the question is how much does that continue, at what scale, and at which banks, right, Alex? And does that mean that the bigger banks continue to see more inflows of deposits, and what does that mean of their overall consumer base?
Do they want more inflows of deposits? Like, can they put that money to work?
Some of the clients, they do, right? In some instances here, you have seen the large banks really struggle to outbid companies like Silicon Valley Bank or First Republic when it comes to the way, for example, First Republic extended loans to wealthier clients.
As the high net worth individuals, sure.
Exactly. So definitely there are some clients here that the big banks really want and they're keeping track of here. But this deposit flight, I think everyone can agree here, is not quite healthy when so much of the economy relies on the regional banks. So this is a broader macro story as well as an individual name story as we look at just how tight conditions get for these banks.
Is this going to be peak NIM? So peak net interest margins, the best they're going to get in terms of that right now?
I think that's an interesting question because all of last year the conversation surrounded around how much interest rates would actually help these banks, and now you're seeing that higher interest rates, because of those held to maturity assets that they have, they're really suffering in other ways. So the lending story, the reason you would think is the peak net interest margin is because you've already seen a historic contraction in lending, haven't we? And that is both in commercial and smaller loans as well.
Well, on the other side, though, you have the deposit beta issue, and now that the sleepy depositors are now aware of that, are they going to have to pay more in deposits in there, and that also squeezes their NIM.
Yeah, and the point that people are making too is that this five-handle idea next to the money market fund is very attractive as you look at clients going to seek the yield instead of keeping their money in a typical kind of depository institution. While we're talking about all of this, there's that kind of undertone here about the decisions the government makes and how they treat depositors moving forward. But again, the next couple of weeks, there's no way that it can't be a little choppy as we watch how these banks kind of sort out the realities that they're facing in this really complicated interest environment.
Really fun. Really looking forward to it. It's gonna be a lot of fun this go. Shalini always thinks it's fun, but All right, Shalini, thanks a lot. Shalini Basak joining us there. All right, coming up, we're going to take the technical take now on the question of the day. What's right, equity or bond markets? We're going to take a look at technical levels as well as gold and kind of what that's telling us about where the market could be headed with Paul Sienna, Bank of America Global Research Chief FIC Technical Strategist. That's quite a title. That's coming up next. This is Bloomberg. It's our question of the day. What's right? Equity or bond markets? It feels like they're telling us different stories. The bond market looking at a recession, the equity market still holding up. I appreciate the fact that we're off a little bit today with the S&P down 0.5, the NASDAQ 100 getting hit, but nonetheless, we're still holding in, not reflecting any recessionary panic. So now let's take a view on the technical side. Joining us now, Paul Sienna, Bank of America Global Research Chief FIC Technical Strategist. We talked about the fundamentals earlier, so let's start with the technicals and the 2-year. We're at 4% right now. What do you see? Where are we going?
Sure. I think the market is flip-flopping every month this year, where January was the opposite of February, February was the opposite of March, and now we're kind of in April. And post-banking crisis of March, yields came down, and they're bouncing back. So I think 2-year yield specifically made a very distinct signal in March when it traded up to 5.08% and collapsed the week that that crisis began to unfold. And in the charts, we call that a key reversal week, where it engulfed the prior 2 weeks of trading. So we know in the charts that's most likely the peak for 2-year yield, and the bounce back in yield in April should be used to get further into the 2-year and essentially buy it.
One more thing on this one is that, last week I was talking, are we going to see 355, which was the low of the year, or 4 again, and then all of a sudden, boom, we're back up at 4.
Right.
Are these gaps going to be what we're expecting now?
I think so, because the market is, trading very dependent on the next data print. They're trading very dependent on the next macro headline, and that's going to cause something like the 2-year to really swing.
And then in terms of the 2-year swinging, trying to make up its mind, right? Then you get the S&P, which is still above all its moving averages. That perplexes a lot of people who are looking at the underlying fundamentals as we head into earnings. What are you watching?
It definitely does. So S&P 500 is capped right now at about 4,200. It's a flat line across the last, call it 6 months or so. And, there's going to be sort of the CTA trade to break like event there. If the S&P gets good news and reacts positively and it breaks higher, then maybe they chase that. Until then, it's capped.
Yeah, but still, it's capped, but really holding up or right around those high levels. The other asset that sort of made a run for it in the last couple of weeks has been gold. I appreciate we're trading a little heavy today. Yep. What are you looking at in gold levels?
So gold looks very good both from the short, medium, and long-term technical perspectives. Ultimately, a backdrop of markets being worried about inflation, markets being worried about the next global macro event, maybe about recession. There are 3 ingredients here that work well for gold prices and should support it. So we think this long-term tide here in gold is setting to break out to the upside in Q2. I would say that Q1 actually ended at the highest quarterly close in gold prices to date ever. So there is, an uptrend there to pursue. And I think if you're a buyer of gold on dips, and as the second half becomes clearer on when things tend to turn in the Fed hiking cycle, gold benefits.
We make new highs?
Sure.
In the second quarter?
Yeah, probably.
Is it going to be a smooth ride? Or is it going to be gappy like we're seeing in other asset classes?
I think it's going to be gappy. Look, gold right now is overbought. Silver is even more overbought. They're all correcting right now, and I think you use this correction to get long.
Hence the whole buy on the dip.
Yep.
Okay, what about crude? It was looking a little painful there. OPEC Plus comes in, providing some kind of floor. What's the floor that you think we're now in?
Yeah, so WTI, front month.
Sure.
Right? Stuck between about $72 to $82 a barrel. It's been stuck there for a few months now. And even an 8% gap on surprise headlines from Saudis couldn't produce a bullish breakout in the charts. So I think the market is essentially using oil prices as the harder landing commodity. Right? Use the rally in oil prices to add to shorts, to fade, especially while it's below the $82 barrel barrier that it's been struggling with, as you can see in this chart.
What do you think the upside potential is going to be? Are we going to hit 120 again?
No, I don't think so, not in this cycle.
No? Where do you think some upside's going to, what do you think the upside cap's going to be?
I think if you break 82, you're looking about $10 higher to about 92. Until then, while you're trading and struggling to break 82, you're going back to the bottom of the range.
What about the dollar? You're the FIC guy.
Yep.
Where are we in terms of the dollar?
So the dollar is in a seasonal trap, meaning April is usually a weaker period for the dollar, but the market has really learned about this over the last few years. And May, it tends to come back with a vengeance. So a vengeance isn't necessarily a good thing, which is why I like gold and why I like buying treasuries on the dip, because it's a risk-averse backdrop in the charts. When we look at things like gold versus the S&P, there's a cup and handle bottom, right? That's bullish gold and essentially bearish riskier assets. So, using this seasonal tide, and as we get to that sort of sell in May and go away atmosphere, I think that's what sees FIC come through after all.
What other currency cross are you watching when it comes to the dollar?
Euro.
Like what's going to move the most?
A major one, right? Euro tried to break 110 twice this year, and it's failed.
Yeah.
So it's questionable if euro is actually double topping and ends up coming back down to 105, even 102. And in that sort of scenario, you have to imagine, well, how does gold sustain a rally if euro's coming down like that because the dollar's strengthening? That's sort of your, 2 sigma standard deviation kind of risk-off event, which is unlikely, but markets are choppy this year. January one way, February the next, right? And they flip back and forth. So they might oscillate in a way that allows, euro to be range bound 105, 110, gold to appreciate to 21.75, oil to stay stuck where it is and probably get pressured lower as we turn the corner of summer and demand slides.
So for euro dollar, you don't think we reset eventually to like a 110, 115 range if the ECB is able to continue to hike and the Fed does kind of one more and done? Can we reset to that higher range?
Eventually. I think that's more of a second half story.
Okay, fair enough.
But not yet.
Before I let you go, I just want to get your take on dollar yen. Do you think we get back to the 150 level for dollar yen at some point, or is that's going to be the highs for the cycle?
So the secular picture, the longest term charts to get, where we can go in dollar yen, it's actually about 175, but not now, okay? I think the story of the yen is very clear in your Bloomberg correlation weighted indices that show a head and shoulders bottom pattern for the yen that suggests strength in Q2.
Interesting.
For the yen. So you would be short dollar yen, short Aussie yen, and looking for yen to be some sort of safe haven.
Clearly, the yen getting hit a little bit today as the new central bank governor says we're going to stay put. We're not going to do anything with yield curve control, but nonetheless, great take, technical take there. Paul, thanks a lot. Super appreciated. Bank of America's Paul Sienna joining us in the technicals. All right, coming up, we're going to talk more about the fundamental shift, equities, bonds, who's winning, who has it right. S&P up by 0.5%. Elise Ausenbach, JP Morgan Private Bank Global Investment Strategist, will be joining me next. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Welcome to Bloomberg Markets. I'm Alex Steele. Guy Johnson is off today. Let's get you check-in here on U.S. markets. European bond markets, equity markets are closed. So the action is in the U.S., and I put action lightly. The S&P is off by about 0.6%. Most sectors are in the red. Now, the good parts of the S&P, therefore those stocks that are actually holding up and doing well, AMD, for example, and Micron up by about 7%. This part's quite interesting. Samsung is going to be cutting chip output. If you do that, prices actually should stabilize and you can make more money for the chips that people are still producing, hence Micron, AMD, holding up a lot better. So is that really an economic signal, or is it actually just they get to make more money for their chips? It seems like the market's taking it the latter way. Take a check in here on the 2-year yield. You're seeing a teeny bit of selling. Yields up by about 1 basis point. Literally like a couple days ago, I was like, are we going to see 3.55 or 4? And now we're solidly at 4 headed into the CPI number. And then dollar yen, somewhat idiosyncratic, but shooting higher, up by about 1.3%. That's as you had the first press conference for the new Bank of Japan governor, Mr. Ueda, talking about the fact that yield curve control is going to stay, not going to make any policy changes anytime soon, and therefore the yen feeling a little bit of pressure there. But this nicely kind of wraps in. You got the fundamental, and then you wind up having the micro. The micro and the macro. The macro really seen on the 2-year and seen for Wednesday CPI, and then the micro is with Micron and what we're seeing on a company level when we get earnings that really kick off on Friday. In the meantime, we do have some news on inflation expectations and the Fed, which can move markets. So Mike McKee's tracking that for me. Mike?
The Fed keeps a close eye on inflation expectations, and we have good news, bad news for the Fed. The New York Fed puts out a survey every month of what consumers think is going to happen with inflation, and they see 1-year inflation rising. The first increase in the series since October goes up a little more than 50 basis points to 4.75% from 4.23%, not the direction the Fed would be hoping. The better news is that at the 3-year horizon, they rose by only 1/10 of a percentage point to 2.8%, and they fell a percentage point at a 5-year ahead horizon down to 2.5%. This is all probably due to gasoline prices. Gasoline prices have been rising over the last couple of months, and in particular since April began and maybe the last week of March, and that registers with consumers, so they have probably taken that on board. The other things that they do say is their earnings growth is unchanged, 3% for the 4th consecutive month for over the next year. They do expect gasoline prices to keep rising, food prices to rise, medical costs to rise, and the price of a college education to rise. So people are still seeing inflation out there, despite what the Fed's been trying to do.
You can understand why the Biden administration did not like what OPEC Plus did then.
And why the why the Fed is still talking about raising rates.
Yep. All right, so let's bring all of this in together here. You're looking at S&P still down by 0.5. You're looking at the 2-year up by now by about 2 basis points. But it brings us to the question of the day, what is right? Equity or bond markets? Now, I want to take this question from the equity point of view. If you take a look at this chart and you're looking at the S&P versus the blended forward earnings estimates, and Mike Wilson, who we know is no stranger to the bear world, says that profit forecasts haven't yet been reflected within the market. You have earnings estimates are still holding up. That could explain why equities keep holding up. Can that continue as the numbers start trickling out? So Mike's staying with us, and Gina Martin-Adams, who's chief equity strategist over Bloomberg Intelligence, joins us now as well. Gina, who's right, equity or bond markets?
Look, I actually don't think the equity and the bond markets are telling you two different stories here. I think they're telling you the same story, and that is both markets are anticipating a recession that is deep enough to really crush the back of inflation and allow the Fed to reverse interest rate policy. Our models would suggest that as of the October lows last year, the equity market was already anticipating a 15% decline in earnings. Analysts have been catching up to that decline in earnings expectation that was already embedded in market prices. But the entirety of the market movement since the October lows has really been about valuation expansion. And our market models would suggest that valuation expansion is tremendously dependent upon the rate of inflation and interest rates. So to me, the equity market and the bond market are telling you the same thing. They're telling you that recession is coming. But that recession is going to result in much lower inflation pressures and also a reversal in Fed policy.
Right.
So from that perspective, maybe they're both wrong because inflation is still running a little hotter than anticipated. The Fed is yet to signal a backpedaling, and that's really the risk in markets at large.
Okay, so I love that view. So basically they're saying the same thing, but what they're both saying could be wrong. Mike, and this data that we just got kind of proves that maybe inflation is a little bit stickier. What do you think?
Yeah, what she said.
Yeah, as we all mostly say, whatever Gina says.
The problem here is, of course, the Fed is taking things month by month and meeting by meeting, trying to figure out what's going to happen with inflation, growth in the economy, where the markets are trying to figure it out on a every 5-minute basis. And so they react a lot more than the central bankers react, and they're suggesting that we're going to see, as you said, a recession that is deep enough and early enough, soon enough, that we will see this big earnings compression for equities, and we'll see bonds having to rise in price and yields go way down because they're anticipating the Fed. The one interesting thing you do hear from a lot of bond market strategists is that whole theory is what they think is going on with bonds, but the actual prices for bonds may not be correct, especially the 2-year at this point, because the Fed is giving no indication that it's going to be cutting rates anytime soon. So maybe the markets have gone, bond market has gone a little bit too far, too fast.
Also, you have to question if they are going to cut that much, like what's going on with the economy that they have to do that. So, Gina, let's just take the idea that if inflation's actually stickier and the Fed has to keep going and they don't wind up cutting, and that's the biggest misprice in the market, where's the biggest misprice within the equity market in that thesis?
Yeah, it's mostly in long duration, sort of growthy type of assets within the large cap index. The small cap index is actually trading at a tremendous discount. It's been in a 2-year plus bear market. The valuations are extremely cheap, so I wouldn't worry too much about small caps. But within the large cap space, you have seen, especially so far this year, longer duration assets rally tremendously. Longer duration are, of course, the stocks that are more sensitive to interest rates. So they've rallied as interest rates have rallied, very consistent with the notion that the equity market is completely dependent upon the outcome for interest rates for a continuation of this rally. I would say those are mostly in technology, consumer discretionary, some communication services. Stocks tend to be relatively prevalent in the longer duration asset category. Though I think you just want to look at cash flow dependency. So to the degree that companies have a lot of their cash flows in the long-term future, they have minimal cash flows in the short term, those are the most risky areas in the market, particularly when their valuation multiples are trading at a premium.
Gina, another quick one on that. If that's where you want to be careful of, what's the safety part of the market right now that hasn't been fully priced?
Yeah, really interestingly, Alex, the safety part of the market is actually the cyclical segments of the market. So the parts of the market that are usually most sensitive to recovery in margins or a recovery in the cycle coming into 2024, there's been little trade into stocks such as those in the industrial space, some of the more retail-oriented consumer discretionary names, the more interest rate sensitive segments in the market where they actually get a true earnings boost as a result of lower interest rates. These are not groups that have rallied tremendously. Even some of the financials outside of banks have not done particularly well so far this year, which is a bit of a surprise considering the interest rate landscape. It's really been all about benefiting those long duration assets again. So the contra trade to that is look at the outlook for the economy. Do you see some recovery emerging in 2024 and into 2025? Find stocks that are somewhat secularly depressed or at least cyclically depressed in terms of valuations that are levered to that improving outlook, and watch the margin lines really carefully because they're going to see that operating leverage improvement first as the economy starts to recover, and that's where you usually get a little bit of a lift.
Yeah, you just really need that micro lens. So let's wrap on the macro. We just talked micro, let's wrap on the macro. Mike, unfair question. The Fed, do they care more about CPI or what banks are going to say about lending on Friday?
I suspect by the time we get to the meeting, they're going to care more about bank lending and what the banks say. The CPI, they have a pretty rough idea of where it's going to come in, and PPI has been in good shape, and they anticipate going forward that we're going to start to see the impact of lower rents on core inflation. That'll bring it down, and that their forecast for inflation in the mid-threes by the end of the year is accurate. But if the banks do report a big contraction in credit availability, then they're going to be more worried about the economy slowing down more quickly. They should have the data by May 3rd, even though it's probably not going to be published until May 7th if they stick to their regular schedule.
Are we allowed to say that? Like bank lending versus the CPI? I don't know if Mike's allowed to say that. Mike, thanks a lot. I appreciate it. Bloomberg's Michael McKee, Gina Martin Adams of Bloomberg Intelligence. Super appreciate it, both of you. Thanks a lot. We're going to put together now the question of the day. What's right, equity or bond markets? I love the idea that they're both right, but maybe they're saying the wrong thing. Well, Elise Asenbaugh will be joining us from JP Morgan Private Bank Global Investment Strategist coming up next. This is Bloomberg.